SEBI has partitioned the Indian market, creating a gated category of assets designed for a specific type of capital. This new regulatory framework has left many investors questioning whether they should maintain their current course or find a way past this new gate to gain an edge. For years, the foundation for most portfolios has been the traditional equity mutual fund, the standard tool for building long-term wealth. But the landscape shifted when SEBI introduced Specialized Investment Funds, or SFs, alongside strict new compliance reporting formats to govern them. SFs occupy a different regulatory space than traditional funds, requiring a different approach to risk and capital management altogether. We can evaluate the utility of both options using three specific criteria: minimum thresholds, risk, and redemption. The fund type you choose dictates how your capital can be utilized in the years ahead. Ultimately, you face a trade-off between the high liquidity of a standard portfolio and the concentrated exposure of a specialized strategy. We start with minimum PAN-level thresholds. This is the entry price for participation. Mutual funds operate with a very low floor. You can start a monthly SIP with 500 rupees. This accessibility allows any retail investor to participate in the growth of the equity markets. This accessibility requires fund strategies to remain broad and heavily regulated, as they are managing public retail capital. SIFs move in the opposite direction. They require massive, localized minimum investments that are strictly mapped to an individual's PAN. These high barriers effectively exclude the average retail investor from the asset class. This exclusion is an intentional feature of the regulatory design. SEBI's massive thresholds act as a filter, ensuring that only capital capable of enduring severe, localized losses is permitted to enter the space. The second pillar is risk and strategy, or the actual market deployment of your money. Mutual funds are mandated to spread capital across various sectors and market capitalizations. This diversification dilutes the risk of any single company failing, preventing a localized event from destroying the entire portfolio. While balanced, this safety net limits potential concentrated gains. SIFs replace this with highly concentrated, specialized strategies. This allows managers to capture explosive growth. However, if wrong, the risk of extreme drawdown is significantly higher than a diversified fund. Accepting this level of risk is only viable if the core of an investor's wealth is already secure. Our third pillar is redemption timelines, which determines how quickly you can convert your investment back into cash. Mutual funds offer daily liquidity, settling most transactions within 1 or 2 days. This provides reliable access to cash during personal financial emergencies. To provide that daily liquidity, managers must keep cash on hand, which prevents them from investing in deep-value, illiquid opportunities. SIFs remove that liquidity, enforcing multi-year lock-in periods or infrequent redemption windows. This stability allows SIF managers to execute complex strategies over many years without worrying about sudden redemptions from investors. For the investor, this means your capital is effectively trapped for the duration of the lock-in. No matter what the returns look like on a statement, that capital is unavailable to you if you face a real-world financial crisis. This quadrant chart helps you decide. Bottom left represents retail investors building core wealth from a salary who require emergency capital access. Here, mutual funds offer optimal liquidity. Top right represents high net worth individuals locking away large sums. Here, SIFs provide powerful diversification. Even for this group, the choice involves accepting complex compliance tracking and absolute illiquidity. SEBI's strict reporting formats exist specifically because these funds carry concentrated risks that require close monitoring. Do not chase a new asset class if your financial architecture still depends on the safety and liquidity provided by the established ones.